All right, so CNBC and Cathie Wood, they're not really getting along right now. And CNBC just had Cathie Wood on an interview. She went on a couple different shows. We're going to react to one of the ones she did with Josh Brown. If you guys don't know him, he's a decent contributor on CNBC. I like him. And he kind of grilled her. It started off kind of nice, kind of just like, hey, happy you're on the show. And then he's like, why is this innovative? And Cathie's just like taking it, and she's taking it. And then she has to finally respond to him. This is really interesting stuff that's going on with Cathie Wood right now. Because either she's going to be really right and Roku's going to go back to $450, or she's going to be really wrong. And it's going to go down as this like person who got Tesla right and this thesis made everything wrong. I don't think that's going to happen because I don't understand how anyone bets against innovation. It does not make sense to me. Like, yes, there's a bear cycle. Yes, the markets are cyclical, whatever. But at the end of the day, innovation wins. That is not controversial to say. Companies that innovate, companies that are taking advantage of things that are going on right now, that are going on right now that are going to matter in the future, not things that are just going on right now that only matter in the present, are going to win. It's just time and time again, that's what it happens. We're not going back into the world of value investing, over decades in order to get a return. That's not how technology moves. Technology moves at the speed of light. And the companies that are innovating are the companies that are going to win. Do I agree with every stock in Cathie's portfolio? No. No, not at all. And that's why I'm thinking of selling all my ARK and just putting it into Palantir, because I'm getting kind of annoyed at a lot of these portfolio moves she's making. Yes, I know she sold Palantir. I'm going to make a separate video on that. Don't worry, it's coming. But let's react to what Cathie Wood is saying with CNBC. And then after that, I have to show you a tweet that she tweeted to CNBC. It was absolute her throwing shade after this interview. Stick around for the tweet because the tweet was hilarious. What she tweeted at them, it was it seemed like she was not happy with how things went down today. All right, let's get into the video.
I agree with you about the pendulum having swung very far. I don't know if it's all the way yet. It's hard to without the benefit of hindsight. But every time I want to pull the trigger and buy your flagship fund, ARKK, two things stop me. And maybe you can talk me and other people who are watching out of these two problems that I have. The first is not in your control, and that is the inflationary environment and what's going on with rates. If this is your strategy and you're going to stick to it, unfortunately, you're up against a headwind that is not of your making, and really there's not much that you can do about until it abates, which is that historically, go back to the last 100 years, break it down in decades. Decades with high inflation were very bad for growth stocks relative to value stocks. Just look at the 2 decades with the highest inflation, the 1940s coming out of the war and the 1970s. In those 2 periods, using FAMA French indexes, value outperformed growth on an average annualized basis by more than 10%. That is an insurmountable hurdle to anybody concentrating in growth stocks if, in fact, high inflation is going to persist.
So this is a good argument, right? He's bringing up some pretty good numbers. I didn't even know this before I watched this. And obviously the argument here is that when inflation rises, interest rates have to rise in order to combat inflation. As a result, technology stocks, growth stocks that are not valued currently, they're valued on their future cash flows, which means they're unprofitable right now because they're trying to gain market share because they are trying to grow. Get a discount in terms of valuation because investors don't feel comfortable putting their money into these types of stocks, primarily because the cost of borrowing capital due to interest rates being higher to combat inflation and to, in general, combat an overstimulated economy is going to mean that those growth stocks have to pay more for the cost of capital. At that point, those growth stocks ultimately don't do as well as stocks that are more value stocks, stocks that investors can feel are safer and that are more resilient against inflationary pressures. So he's making this sort of thesis claim, and he's bringing some history into it, and from the 1940s and 1970s, that when we have had high inflation, an average of 10% of value stocks outperform growth stocks on an average of 10%. And what he's basically telling Cathie is like, you're not going to solve this. Like he's starting this argument by saying, you literally have nothing you can do about this. And I'm really curious what you think you can say to beat 2 decades of historical data. Like, how do you get yourself out of this, right? That's the argument he's trying to come up with because this is a macro level economic thing. It's not a Cathie Wood. It's not even about stocks. It's not even about her stocks. It's about you are in a sector that just doesn't do well during this time. What are you going to do about it?
Again, that's not your problem, but I'd love to hear your take on that. The second thing is a little bit more idiosyncratic to ARK and the way that you guys do portfolio construction. which is that there tend to be a lot of glamour stocks in your index and in your products that maybe aren't that innovative. And a couple of examples that come to mind, I was kicking the tires on your genomics fund. I can't get past the fact that Teladoc is the largest holding. In what way, shape, or form is Teladoc at all involved in genomics? DraftKings, Robinhood, these are not really innovative companies. One is a bookie, and one is a fairly traditional broker that made its way by breaking a lot of brokerage rules. I don't see an.
So Josh Brown is throwing a lot of shade here, right? So first of all, he's like, I don't know how any of these stocks you're saying are innovative are actually innovating. So that's his first argument. His second argument is like, how is Teladoc innovative? I think he's just been waiting for this opportunity because he's been saying this on CNBC forever. He's just been waiting to tell her face to face, how the heck is Teladoc innovative, right? Like, what is innovative about it, especially if it's the largest holding in the genomics fund, which is supposed to be this like revolutionary stuff that's going to cure all these diseases, right? So he's grilling her. This is one of the toughest I've seen people be on Cathie Wood on CNBC. He's literally asking her face to face, why is any of this stuff matter?
Innovation there when I see those names, and that's why I'm not an investor as badly as I want to be. Can you talk me out of those concerns that I have? Because I think they're shared by a lot of the people watching today.
Sure. Absolutely. And Josh, I heard that you had some kind words to say about us as a firm or generally. So I thank you for those a few weeks ago.
I think very highly of you.
Thank you. Thank you, Josh.
That was weird. That whole exchange. Does anyone else think that was weird? It's like, why are they... Like, first of all, it's weird. Cathie said, thank you for speaking highly of us last week. I'm like, it's not like it's bad to say that. It's just like kind of weird, right? It's, to me, like, I would just answer the question and just go straight into like, all right, what do you like, here's why they're innovative. It seems like she's kind of setting things up to be a little bit nicely because maybe her answer's not going to be that good. And she wants to get Josh to be a little more friendly, given Josh came in flaming hot. But that whole exchange to me was very weird. That's something you would do like in the very beginning of the thing, not in the very middle of her answer. I don't know. It's stupid for me to even point this out. But this whole thing is weird. Like when I saw this initially the first time, I felt like Cathie was like weak, just like answering this. Like I felt like she was like kind of scared almost to answer this question. I'm not saying she is. It just kind of felt like to say thank you for being so nice to us and like easing into this answer. Like if you want me to feel firm and adamant in your advice as like an investor and like your thesis, I want you to just like, the way I would be like, well, Josh, that's a good point, but honestly, people don't get what they're talking about right now when it comes to inflation. Look, here's what's going on right now. We really need to, now maybe that's just my approach, but I would just immediately attack it and show full confidence around all the doubt that people have right now and fear that they have about my fund. I don't know. Maybe that's just me. Let me know your thoughts in the comments. It kind of felt a little weird.
So on the first, inflation, okay, my background is economics, both economics and finance. And
this part was also kind of weird to me. She starts like going through her background in economics. And now it's good because it does it. So from a communication perspective, it solidifies her credibility to new people that are watching. So it's like, oh, she's credible. She knows what she's talking about. She's done economics. But in all reality, it's not an argument. It's just like, it's like me telling you guys like, hey guys, I did debate, which means I'm a good speaker. It's like, it gives you a little bit more credibility about, okay, this kid in high school did this debate program, so like he knows how to speak. But I have to actually be good at speaking for you to care to watch the videos and consume the content, right? I can't just be like, hey, I'm this like debater person. So telling me she's done economics before, I'm like, okay, but like, well, why is Teladoc innovative, right?
I do have a point of view here. The supply chain issues have lasted so much longer than we anticipated that they would take a while to work out, but not 2 years. So the question is this supply chain related? And will these inflation metrics unwind? I think a lot of what's going on is supply chain related. I know it's become unfashionable to use the word transitory, and so we won't, because it's lasted longer than we expected.
So they still believe it's transitory, by the way. Like, just because you're not using the word, you believe it's transitory. She literally just tweeted 5 days ago a quote tweet saying inflation is transitory, and she put it with an exclamation point. So she's doubling down on this. She doesn't want to say it publicly because it's kind of like it's a politics thing, right? So for example, the guy, the Chris Murphy, the guy who's the governor of New Jersey, he recently unilaterally decided to stop the masking mandates. Why? Because he narrowly won in New Jersey as a Democrat in a state that votes majority Democrat. So when they did polling data on the people who didn't vote for him, their number one concern was these masking mandates. They were like, this is horrible. Like, this is why we didn't vote for you. So he took this information to the White House. He went to President Biden and he was like, bruh, we've got to do something about this masking mandate because the midterms are coming up. People hate this. In New Jersey, I barely won. It's a heavy Democrat state. You should probably come out and tell people to get rid of these masks. And Biden ignored his advice, right? So some states, and he's one of the main ones who decided to unilaterally make this declaration, is allowing New Jersey to not have masks anymore. So my point here is this is a perceptions issue, right? Like, he knows he needs to get reelected and he's trying to help Biden get the Democrats reelected because he's part of the Democratic Party. And he's like, this perception is something we have to shake off. Cathie, as an investment advisor, someone who's trying to pump up her fund, she's not using the word transitory or not wanting to use the word transitory because she knows the perception with that word, the stigma and toxicity with that word is so horrendous right now because of how much of a lie it's basically been over the past 2 years or a year and a half of us hearing that the inflation is transitory, that that word itself is triggering. So, this is, but she still believes in the argument. She's just not saying the word, even though she said the word on Twitter 6 days ago, but she believes that this is going to go away. That is ultimately her thesis. And to be honest, she has to believe in that thesis in order for her to be correct about this. However,
I do think there's going to, the deflationary forces that are building up in the economy today are pretty strong. Two are secular, one is cyclical. And the bond market is sort of getting this. If you look at what's happened to the yield curve, so the difference between long rates and short rates, it has flattened from, I think, 155 basis points last March to 45 basis points today. And if the Fed did go 50 basis points in March, which they might, I think that it would be one and done then, we'll end up with an inverted yield curve. And then what are people going to think? Well, an inverted yield curve and the flattening yield curve says, watch out. Something's going on here. Either growth is going to disappoint or inflation is going to be much lower than expected, or both. And we think both is right. And so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup in the fourth quarter GDP report, you'll get a sense, while inventory to sales ratios might be low, as the consumer switches off here. And if you look at the last 3 months of either retail sales or...
Okay, this is going to be one of my last interruptions, then I'm going to let her speak for the last 3 minutes. This is one of the things I'm a little bit worried about when it comes to Cathie. I kind of feel like she's in the Meet Kevin camp right now. And my thing on Meet Kevin right now is he's so into every single report that comes out, which is great. It's great analysis, all that stuff. But like, even he admitted it, he's so into every single thing that sometimes your head might just be so deep into it and you're looking at all this research and you're trying to connect the dots and you're like, all right, I connected the dots. And then maybe the dots weren't connected the right way. And I'm like, I'm hoping that this whole inventories argument and supply chains argument research is correct for the case of ARK and for the case of growth funds. But if it's not, then it's just a bunch of research her team has done that might not be correct. I mean, I don't know. We'll see what happens.
Or consumption, the consumer has gone pretty flat. Meanwhile, you've got the double ordering and triple ordering by manufacturers and wholesalers because they were missing sales before. So I think there's a big inventory problem brewing here, and it's going to hit within the next 6 months in terms of that recognition. That's the cyclical side of inflation. The secular side has to do with innovation. So our focus is understanding cost declines associated with technology and when costs are going to drop low enough so that demand in different sectors will pick up. Just give you a few examples. So for every cumulative doubling in the number of whole human genome sequenced in the world today, costs drop, the cost of sequencing drops 40% if you're Illumina, 28% if you're a PacBio on the long read side. Robotics, for every cumulative doubling in industrial robots, cost decline 50%. We have major labor shortages. So that cost decline will cause increased adoption and will lower the risk associated with wage inflation continuing. And then artificial intelligence costs, I gave that one down 60% per year if you include both hardware and software. These are major, major deflationary undercurrents. The other side of disruptive innovation is creative destruction. And what does that mean? It means the existing world order, the traditional world order, is going to face disintermediation and perhaps destruction. And we certainly see this in everything, transportation, in retail. There's still a lot of creative destruction taking place,
right,
in the healthcare space, right? So what's going to happen is these companies whose products are either going obsolete or who have not invested enough to update them, they are going to have to cut prices. So we see major deflationary forces, and I think the bond market is on to this. If I didn't see some signal supporting what we're saying in the marketplace, like that yield curve, I'd probably say, gosh, I don't know how long this is going to last. But I have a feeling these deflationary forces have entered the bond market cycle.
All right. So, I mean, her overall thesis argument is like, look, tech is deflationary. Supply chains are held up. Inflation will go away once supply chains get better because these inventories are gonna stop getting stacked up in these warehouses, which means consumer demand is also going to decrease a little bit. Less money going to the economy. 50 basis points rate hikes means that there's not going to be that much more interest rates to worry about. The market will factor it in, which I kind of think the market already kind of factored in the fact that there's going to be 50 basis points of rates hike. I mean, it might go lower, but who knows? Which means her argument is the same as what she's been articulating for the past couple of months, which is like, inflation is transitory, tech is deflationary, you got to give it some time. And she made a prediction here. She said 6 months. She said in the next 6 months, we're going to see really what's going to happen. So she's giving herself a timeline, and it's super interesting to think if it's going to happen. Overall thoughts that I have, and I'm curious to know what you guys think in the comments. Do you think it's full of BS, or do you think there's actually an argument she's making here? I think she's right. I mean, I do think she's right. Now, I'm skeptical because of what we've been seeing in the market, but that's just this random guy being skeptical, just like any random guy can look at the market and be skeptical of her. It's easy to be skeptical when everything's down. I'm invested in a high growth tech company that I genuinely believe in. I think high tech growth in general is going to have a lot of winners more than they're going to have a lot of losers. And those companies are going to have a competitive moat, whether it's having AI, whether it's having robotics, whether it's having genomic sequencing. It has to be some type of competitive moat that is so fundamentally differentiated. And you're such a winner in that space that you're ultimately able to survive. And I feel that those companies are going to be the companies that win in the next 10 years. Like, it's just very obvious to me. These companies are going to have absolutely exponential growth. The question becomes, when is that going to happen? And is that going to be able to happen if we don't get rid of inflation? So it's so crazy because all of this comes down, this whole war that she's having with CNBC right now, it comes down to, is inflation transitory or not? It's just that simple. Because if it's transitory, the bull market rallies because we don't got to worry about this anymore. The Fed's gonna not be that hawkish. Investors are gonna go right back into growth because that's where the money's gonna be. It's gonna be a party. It's gonna be a freaking party. Like, it's gonna be great. I'm gonna have 2,000 shares of a certain stock inside of that party. But if this inflation thing doesn't go away for the next couple of years, then it's not going to be a party because investors are, like, as he said in 1940, 1970, those stocks just don't perform in that environment. So the question becomes, is inflation going to go away? I tend to bet on yes, based on not only her research, but based upon the arguments around interest rates and the ability for us to stop spending money as a society, particularly because of consumer sentiment going down based upon a lot of surveys and research that ARC has done and that I've seen as well. So it's like, I think there's a very strong argument for inflation going away. Like, I don't see us getting above 7.5, 8, 9, 10%. Like, I don't see that necessarily happening, especially when we raise interest rates. It's just a question of when does that happen and when does sentiment change to the point where investors know that the money is in growth. Like, the money is in growth. The exponential money is in growth. It's not anywhere. It's in growth. The question becomes, when is it time for us to be able to go rake in on that money and really double down on those investments in money? Because a lot of people are scared to do it right now, even though right now is, I think, when you should really be doing it to get those crazy, crazy exponential gains. I don't know. We'll see what happens. Let me know your thoughts in the comments. Cathie Wood, CNBC. Oh, I didn't even show you guys the tweet. Here's the tweet right now. I'm going to put it here. As you can see, Cathie is saying, she made a joke and a pun on Zoom. Talking about CNBC couldn't pay for this because the CNBC is cheap, apparently, because they're paying for the free version, or they're not paying anything for the free version. But Cathie and ARC is betting on Zoom. So yeah, let's see if this plays out. Let me know your thoughts in the comments. Thank you guys for watching. I'll see you guys in the next one.